Hi everybody, Luke Gromen, FFTT. Hope you are well. Hope you had a great week and weekend. It was a beautiful one here again in Ohio. Summers are the best. Really appreciate everyone submitting their questions. Thank you. Very helpful. Really enjoy the interaction and the thought process it drives. So with that, let's jump right into some of the questions. First question is from Jay. Luke, can you please share your thoughts on how you think stock index funds like the S&P 500 or international funds will do going into the future? In the past, these funds have done well as buy and hold funds, but curious how you think they will fare going forward. My base case has been for the better part of a decade and continues to be that the ratio of the S&P 500 over TLT, the long-term U.S. Treasury ETF, will continue to rise inexorably, driven by passive flows, driven by what is essentially an escape from financial repression of treasuries and other Western sovereign bonds. Basically negative real rates, money moving out of sovereign debt into assets that better protect purchasing power, like stocks. An emergent longer-term concern of mine. It's on the radar. It's not a huge concern, but it's something that has been put in front of my attention just by watching, which is Chinese competition, number one. Things like just year to date, DeepSeek, BYD in the electric vehicle space in terms of some of the market share they have gained. For 30 years, I've been doing this 30 years, and for all 30 of those years, it's been considered by American investors that high technology is kind of the birthright of American crown jewel corporations and will always continue to be so. And maybe it will, but what if it's not? What if the competition from China around the world actually has stepped up to the level where you start to see some of American crown jewel technology names lose some share? Not saying it's going to happen, but for the first time in 30 years, there's a credible competitor in certain areas of dominance where the U.S. has typically dominated for the last 30 years. So that's one area of, like I said, not a huge concern yet, but it's on the radar. It's an emerging concern. The second is something that Jordy Visser pointed out in a recent conversation with my friend Marty Bent, that who knows, with AI applications, AI is on a lot of ways very democratizing, decentralizing. And so there are probably companies that will disintermediate, dethrone S&P 500 companies remarkably quickly. And they're maybe not even companies yet, maybe haven't even been formed yet. And that's something where, yes, they will eventually end up in the S&P 500, but the pace of AI development is something to think about in terms of my base case. Again, I'm not fully there yet, but when you look at something like a Palantir, and I'm not recommending Palantir, but take a look at how fast Palantir has come out of nowhere and how big their market cap is relative to the incumbents in the defense space as part of the S&P 500. And is Palantir going to be the last innovator leveraging technology to be able to do that? Probably not. So it's something we need to keep an eye on. It's something I need to keep an eye on, as it's my base case that S&P over TLT will just only goes up, as it kind of has. But I'm starting to keep an eye on those things. So as I like to say, let's watch. From Rourke. Hi, Luke. How do you see the impending rate cuts versus inflation rising expectations playing out, especially in light of capital already so far out on the risk curve? You've got altcoin treasury companies popping up, Bitcoin treasury companies proliferating. Usually we see these post-rate cuts, and yet credit spreads are low. Isn't this all a bit of a mixed bag, things at different junctures of the cycle being seen together? How does this make sense work out eventually? In my opinion, it's critical to remember how we got here, right? So we had an equity bubble, it popped, we kicked the problem upstairs to the banking sector and the housing sector, created a housing bubble, it popped. We kicked the problem upstairs to the treasury market by backstopping virtually everything. Now the credit risk is at the treasury market level, except treasuries have no credit risk. The government can always just print the money to make interest payments and avoid default. So there's not credit risk in treasuries, only inflation risk. So in my opinion, what we're seeing in Bitcoin treasury companies in particular is logical in light of this primrose path that we've followed over the last 25 years. As more and more people begin to realize that the only way out of this is severe devaluation of U.S. debt, of U.S. sovereign debt, of Western sovereign debt. And In that case, I would expect credit spreads to remain relatively low because all else equal, I'd rather own an Apple bond or a Microsoft bond than a U.S. Treasury bond. And now, huge caveat, unless the U.S. government ever decides, even for a period of time, to stand aside and let the Treasury market dysfunction, but then you're going to get credit spreads to really blow out, as we've seen. The credit risks of everything goes to the moon except for probably gold in that case, to be honest. So, but again, I don't think that's going to be allowed to happen for more than a few weeks, few days at a time. And so ultimately, I think what we are watching in terms of a synthesis of what you described is something we've long called for to happen and referred to as Argentina with U.S. characteristics, or U.S. with Argentina characteristics, however you want to phrase it. Stocks are up this year in dollars, they're down in gold and Bitcoin. We're seeing pressure from the presidential administration on the central bank president because they need interest rates down to be able to afford the debt, to be able to reduce the interest expense, to reduce the fiscal pressures. We are seeing the socialists winning the mayoral election, the mayoral primary in the capitalist center of the world, arguably, in New York City. You're seeing other socialist mayoral candidates do very well around the U.S. So these are the types of things that it's all Argentina with U.S. characteristics, dynamics, and I think that's what we're watching. So to me, the risk ultimately remains less nominal risk and nominal credit risk and more inflation risk, real risk, inflation of the currency. And again, to be clear, I'm not saying we can't have periods of risk off. We absolutely can. And there are different things showing that on various metrics, we are stretched technically in certain metrics. But I'm simply saying that you can't have risk off for very long without it creating a problem in the Treasury market. And we have seen 6 or 7 different times since the third quarter of 2019, the problems in the Treasury market are papered over essentially instantly. We saw it again just in April. 7 days after Liberation Day started, Treasury market started to dysfunction. Trump said the Treasury market's getting a little queasy. Boom, he folded. It was the genesis of the taco acronym. Trump always chickens out. The Treasury market is sacrosanct, and that is ultimately what I'm saying. So, next question from RM. All the chatter around sovereign wealth fund and capital controls that we saw from the Trump administration has died down. The only form of capital controls that we've seen is introduction of remittance tax. Do you still believe that capital controls are a must for achieving manufacturing goals? In essence, yes, broadly defined, right? I would take a broader view. MP Materials investment by the Department of Defense 2 or 3 weeks ago. Watch and see what they do there. If they cram down the Chinese share of ownership of that company, if they cram down private investors. Take a look at the golden share stake the U.S. bought in the U.S. Steel, Nippon Steel deal, where the U.S. has final say. That's capital controls of sort. I think you're going to see more of these types of deals and stakes to come. Maybe bans on Chinese investments of various sorts in the U.S. There's certainly been discussions around that. So ultimately, for the U.S. to be able to reshore manufacturing, you're going to have to change the capital flows that define the prior currency system over the past 40 or 50 years. And so whether you want to call those things capital controls or regulatory changes or rebalancing of trade or tariff, whatever you want to call them, yes, you have to implement those things to successfully reshore U.S. manufacturing, in my opinion. From Jim, any thoughts on the timing of the inevitable reversal of passive investment flows, a la Mike Green and others, and how the Treasury may be preemptively taking steps to manage the impact on the value and rates of its Treasury issuance of an unwind of those passive flows? I guess I would ask / challenge, why is a reversal of those flows inevitable? I mean, in a truly market economy, in a true market, sure, they'd be inevitable. But we haven't been in a true market in this country in over 15 years. And in my opinion, assuming a reversal of those flows ignores the political economic impact. What do I mean? You reverse the flows of passive, you're going to get dollar down, flows out. You're going to get stocks down. You're going to get receipts down. You're going to get deficits up, with stocks down and receipts down. With deficits down, you're going to get issuance up, you're going to get rates up. Rates up, you're going to get GDP down. GDP down, you're going to get receipts down, you're going to get issuance up, you're going to get rates up. You're going to get a collapse of the economy. And it's possible maybe you get dollar up through all that. It's possible, okay, maybe you don't get dollar down, maybe you get dollar up. Even if you get dollar up too much, you're still going to get stocks down, receipts down, deficits up. You're going to get GDP down. You're going to get rates up. So you would be talking about a debt spiral and collapse of the economy if we sort of let some sort of demographic unwind of passive investment flows happen. And so from a political economic standpoint, I think there's zero chance of that being allowed to happen. I think they will do whatever they have to do in terms of injecting dollar liquidity in order to keep it going. Now, what does that look like practically speaking? How many times have we heard over the last 6-7 years? Well, we're not injecting liquidity to cap rates or to stimulate markets. We're simply ensuring that the Treasury market remains functional. We want to maintain the functioning of the Treasury market. Tomato, tomato. They're injecting money to make sure that the asset prices move the way they need them to move. So politically, there's not even a choice. They're going to do whatever they got to do to inject liquidity to ensure the Treasury market stays functioning. And I think it has been, and I think it will continue to be more than enough to prevent the otherwise inevitable unwind around demographics, around passive investment flows. From LH, nothing stops this train is becoming consensus, or maybe it's just my echo chamber. Either way, does that worry you like it does me? I think it's certainly become much more mainstream, and hat tip to my friend Lynn Alden. I've said many times to friends, I wish I would have thought of that. It's a wonderful cultural reference to describe the train we are all on, whether we want to be on it or not. And I think among some people, yes, it's certainly got much more well known, and kudos to Lynn for that. However, I'm still routinely called a clown or used the clown emoji by some in the status quo incumbent policy-making neoliberal economic class. So those folks who've sort of made economic policy for the last 40 years, heck of a job, Brownie, they're still in the anger/bargaining phase of grief about the U.S. fiscal situation, debt situation, Western sovereign debt situation, the U.S.'s relative competitive position against China that has eroded notably over the last 10 to 20 years. Once those people begin saying nothing stops this train, then I think it'll start to have become consensus. Then maybe I think we have to start thinking about it being consensus and to consensus. But my sense is that Bitcoin, gold, and probably equities probably going to be quite a bit higher by the time that happens. From Tim. Hey Luke, love your content. Thank you very much. It's been eye-opening to me. I thought the yield curve inversion for sure signaled a recession. Do you think the yield curve inversion doesn't matter anymore? Don't feel bad. 2022, I thought it mattered still too. I would argue, that most economic signs suggest we did have a modest recession in summer of 2022. You had receipts down double digits. You had the ISM in a recession. Lots of stuff weakened. Employment really didn't fall off, so that's the one that it didn't. But I thought that was signaling a recession, and it wasn't ultimately. And so does it matter? I don't think the yield curve is going to matter until we get on the other side of sort of this part of the cycle. What do I mean by that? I realize in 2022 and beyond for certain that policymakers would adjust dollar liquidity as needed to prevent a nominal recession, number one. Then more recently, I've learned that the Fed has not sold any 10-year treasuries, 10-plus year treasuries. So any treasury with a tenor of 10 years or more, boy, is that easy to say. Fed has not sold any of them on net since 2010. Since 2010. They've gone through 2 episodes of QT, and their holdings of 10-plus year treasuries haven't fallen at all. So when I learned that, in light of sort of everything else, I increasingly was of the view that the long end is not a real market and hasn't been for some time. And that, in fact, there's already been a soft form of yield curve control, certainly over the last several years, which is certainly, in my view, the message of where the price of gold and the price of Bitcoin are trading today would suggest, right? So, you would expect, if there was a soft form of undeclared yield curve control at the long end, you would expect the price of gold to double, check. You'd expect the price of Bitcoin to be above 100,000, check. So that's what I'm saying. So to answer the question directly, no, I don't think yield curve inversion matters for now until we inflate away enough of the debt. We go back to sort of a more market-driven debt cycle rather than a political economy-driven one. And I don't think it's going to matter until then. And then finally, from Chris, read Lords of Finance on your recommendation. During the Depression, the gold standard acted as a straitjacket on central bank policy. What would be different today? How would current central bankers conduct sound monetary policy on a hard money standard like gold and or Bitcoin? So I think, it's frequently left out by critics of gold as it relates to the Depression is that the problem wasn't gold. The problem was they fixed the price of gold to the dollar at far too low a price relative to how much money they printed for World War I. They should have devalued the heck out of the dollar and all the European currencies relative to gold. That was the issue. And the Europeans, to be clear, did. The Brits went back onto gold at like a laughable conversion rate. They went back to pre-war parity, pound to gold, after they had printed a bunch of money to fight the war and gone into a bunch of debt. Well, of course it was constraining. It was naive, hubristic, stupid, whatever you want to call, but they should have devalued the heck out of the pound. The U.S. should have devalued the heck out of the dollar. That was the problem with gold. Now, that was the first problem with how they managed it in the Depression. The second issue is that you don't want to peg gold or Bitcoin to your currency. You want to use it as a neutral settlement asset whose price floats in your currency and in all currencies. And when that happens, that's going to allow you to, it is a more restrictive policy in theory in terms of deficits and what have you, but it's not so cruel or hard money that, when you're fixing gold or Bitcoin at a fixed price to your currency. So, you have a floating price of gold or Bitcoin in all currencies, then your currency, as you run deficits, your currency is going to fall relative to creditor currencies. Similarly, when the Chinese run mercantile policies and they run these big surpluses, making their manufacturing more competitive than ours and lots of others, then gold and Bitcoin are either not going to rise as much in their currency or it's actually going to fall in their currency. And so you will have a weakening of the dollar relative to the yuan through the Bitcoin or the gold link. That's the big difference. And I think it's super important to understand because, like I said, a lot of these people arguing against, well, we could never have gold in the system again because it made the Depression worse. It didn't make the Depression worse. The policymakers at the time made the Depression worse because they hubristically, arrogantly, naively, stupidly refused to devalue their currencies relative to the economic reality on the ground, which was Europe ran a bunch of debt that they couldn't pay back in a war that was beyond stupid and beyond pointless. And so if you're going to fight a stupid, pointless war, the end result is you're going to devalue the heck out of your currency against gold. You can't try to maintain some parity to the pre-war currency relationship to gold, a hard money, when you've run up a bunch of debt on a pointless losing war. So that's a little bit of truth speak there. But I think it's really important because it's something we often hear. We say, well, a neutral reserve asset could never work. It could absolutely work. And it's the solution to Triffin's dilemma. It's how you cut the Gordian knot of Triffin's dilemma. So with that, I'm going to sign off for today. As always, thank you for joining me. If you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, and how they're making us think differently about the world, changing our view of a way we had previously been thinking, or confirming something we had previously thought. So enjoy the rest of your week. Have a great week. Look forward to chatting with you soon. Take care, everyone.